So my name is Naeem Aslam. I work as a chief market analyst at AvaTrade. I head the entire research department for AvaTrade. All the analysis that you see on our website on a daily basis and the videos that you see, you know, they are made by me, they're produced by myself. And if you guys seen me, great. But if you guys haven't, then please do feel free to catch us next time. Earlier today at 11 a.m. London time, where I am based, we had a live session on YouTube where we gave you guys the opportunity to ask as many questions as you can. And you know, it was a very good and great session. Again, the recording of that session will be uploaded on our YouTube channel as well. So once again, go through that and then see if any of your questions, most of them, majority of them, I would say, they are pretty much the same. So any of your questions over there that you may have with respect to markets, that must be answered in that particular video. Now, just a little bit about yourself, guys. So please start introducing yourself. So the first question that I want to ask from you guys in a series of 3 questions is say yes if you guys have been trading for under a year. Okay, and now please say yes if you have been trading over 2 years. All right, the reason that I've asked you these questions is because as always, I want to emphasize on this particular point that I want to break my webinar to a level where you guys can really understand them. So bring it to a very elementary or intermediate level rather than keeping it at a very expert level so that you guys can really understand what I am really referring to, all right? Now, the final question is that have you guys have attended any of my previous webinars? Because as always, I hold webinars every Wednesday at 1 p.m. London time. So if you have, please do say yes. If you haven't, please say no. So that just kind of gives me an indication that how many people have actually attended the webinars and how many haven't. So I see that majority of them are saying no. So okay, so that's okay if you haven't attended it, but because like I said, as always, you can watch the previous recordings on YouTube channel, which I will go through in a bit, right? Okay, so let's begin, folks. But before we do that, we need to go through this important slide of disclaimers and risk warnings. So meaning anything that will be discussed in this particular webinar cannot be perceived as an advice. Now, if you are considering for one, please do consider consulting with your own financial advisors who will be much aware with your situation and guide you according to that. This is purely and purely for education purposes, right? So now, having said this, now, coming to the point of contact information and then how you guys can really interact with us. So there are 2 ways. Now, first of all, guys, as always, I want to emphasize on one particular point, which is the importance of having Twitter. It is absolutely critical for you guys to, to have Twitter accounts. Why? Because in this day and age, what do you get is you get news published, the major headline published on Twitter well before then the actual print will come out, the full news will come out, and it takes time for for outlets like, you know, Reuters, Bloomberg, CNBC to publish the story on that. But the Twitter is the most effective way of getting that information. So if you are trading euro dollar, for example, today, you know, the news came out about EU approving the loan, you know, the 50 billion loan, that the joint debt deal. So that obviously produced some movement in the euro currency. But before anything else, the news came out straight on if you had a Twitter, you would hear that pretty much straight away because the news came out, but the actual story came out a little bit later. So that can really leave you in a black spot for that particular period while you are trying to search what really is going on. But if you have Twitter and you have the notifications enabled, these notifications will come straight on your mobile phone there and then you'll be able to do that. And I can assure you folks that I am very, very active on my Twitter account in breaking all those news. Again, I will show you the Twitter account for my in a bit. The second thing that I want to discuss with you guys is our YouTube channel. On a daily basis, I produce 2 different videos. So first of all, it is your fundamental video. In this particular video, we break down things in a way that you can easily digest them and understand the important factors that are likely to move the market on that day. And more importantly, for those of you techie guys who like to do technical analysis, who like to understand the technical zones and everything, which we will again discuss in a lot more detail later on. There is every single day, there's one technical video which is uploaded on our website, on our YouTube website as well. And the instruments that I really focus on them are the ones which are likely to see higher volatility, or there is a major news flow on that instrument, meaning the instrument is likely to see more up or down move. So that's why, you know, we pick those instruments for you. Now, where to find them, where to get all that information. Now, first of all, in terms of a Twitter, here is, I'm going to pull out the account for, this is my account, as you can see, and you, in that you can see that the EU Commission, the tweet came out. We went straight out of that, and all that really critical sort of information is really there for you guys to understand. So if you are following us on Twitter, all what you got to do is then just sorry, let me just keep an eye on audio, because I just wanted to make sure that you guys can still hear me or not. Hopefully you can. Yeah, the mic is still working. So all what we want to do, all what you guys got to do is come here and then subscribe, and then you will get all the information. Now, with respect to AvaTrade's account, it is of critical importance that there are obviously some fake accounts on Twitter. So you follow AvaTrade's account, the one which says the blue tick, the verified sign. This is very, very important. Again, all those important information is also published over here as well. It gives you kind of a flavor of everything. And in here, what I have is just a very short, quick 2-minute video. What I think about the market, how the market is really likely to move on that particular day. Now, in terms of our information, our bigger blog, the fundamental articles that we produce on a daily basis, you can also get all of that information from our website. Come under this trading education blog, and then here you have all those major fundamental articles published on a daily basis. So you can really, get all that information for free at no cost. Just come and then just get the information from here. Now, let's continue with our presentation. Now, agenda for today. Why, first of all, we're going to look at why we want to trade indices, right? And the inverse of indices. We will also try to touch something on that as well. And of course, the fund flow, like whether the indices are looking at the fund flow. We may not be able to touch on the fund flow because just the level of complexity and the level of audience, the education level that we have, I think the fund flow could be just slightly difficult to digest in this small webinar that we have. So, but I will certainly try to touch on that as much as possible. And the last 2 points is like when we will be actually looking at the indices and then defining the levels, understanding the price action and making a meaning of that. And then see like, why that particular movement happened, and then what is next for the price action from there onwards. So without any further delay, let me pull out the MT4 platform, and as always, this platform can be downloaded from our website, avatrade.com. Now, folks, why do we trade indices? The reason that we trade indices is like, rather than trading a large number of stocks for which you would you would need a lot of capital, right, to begin with, and then still you are not fully diversified. The benefits of trading indices is that you are pretty much diversified across a large number of sectors, and also in a lot of cases, you're likely to see a major movement because you may end up picking up a stock which has only zombie moves, and it may be a tech sector, it may be a pharmaceutical banking sector, but maybe the stock doesn't have any volatility, meaning that doesn't really give you an opportunity to day trade. But if you are a passive investor, you don't like too much volatility, then that is the place for you to go. Then that is absolutely perfect. But at the same time, you need to be more certain about that stock, that the stock is in the right direction, right? Because you are not hedged. And if there is a stock which is more powerful within the same sector, it has the tendency to bring the prices of those stocks lower as well, which also have they hold strong books, balance sheets, and everything else. But because a major leader in that sector, for example, Apple, in the tech sector, if Apple starts to fall, it is highly likely that the tech sector is likely to go to move lower, especially semiconductors and stuff. But in the indices, when we trade indices like the DAX and the Nasdaq and S&P 500 index, what you get is, you get exposure to large number of stocks by just buying one single instrument. And then you don't need that much of a capital to begin with, as you may need with a large number of stocks that you want to perhaps want to trade in order to achieve the similar sort of or even close enough to that kind of an exposure. So this is why investors like to trade indices, and especially folks, when we look at index, like for example, when it touched COVID-19 low, you can just trade the index, and then you can just gather, you can just really bank on this sort of a move, rather than looking for each stock, and then that stock may or may not have the similar move. But we know the index has recovered more than 50% of its losses already, so it is pretty good from that perspective. Now, sorry, just the throat is just getting very dry. Now, as always, what we're going to do is we're going to begin the analysis of the price action and then indices. Now, if you want to trade the German market, the index for you is obviously the DAX index, right? Because that covers the entire German market. If you want to trade the, let me bring out something slightly bit more over here. So like right now over here, if you just focus over here for the time being, let me just maximize this one just to show you guys. So if you want to trade the S&P 500 index, then it is your SPX. If you want to trade the German market, then it is your DAX. If you want to trade your French index, then it is your CAC. If you want to trade Italian, it is your FTSE MIB. And for the UK, it is UK 100, right? So these are the different indices. So depending on what index you want to trade, you can just choose that particular index. Now, when I am looking at the indices, the first thing that I always do is I go onto a weekly time frame. Why? Because this is where the bigger trends usually form, and then these trends are likely to hold more value than smaller trends. So it is very important for us, folks, very, very important for us to pay attention to the bigger time frame, because bigger time frame is the direction where you likely wanted to place your trades, right? Now, when we look at the DAX index on a weekly time frame, what we see is on this weekly time frame is that 3 different moving averages, and then I will go through a little bit slow on this one, and then for the rest of them we're just going to pick up some more pace now, because the concept is going to be the same. Now, on a weekly time frame, you have 3 different indices. First of all, it is your 200 week moving average, not the day. Then you have 100 week moving average, again not the day. Followed by that is your 50 week moving average. Now, it is obviously the same for all other derivatives as well, so I will not repeat that again. Now, when we look at the price action, the first thing that we look at is where the index is trading with respect to moving average. Is it trading above any of these indices, or is it trading below any of these indices? Obviously, if the price is trading below these moving averages, that means the price is oversold. The price is much cheaper as compared to the normal levels. So that represents an opportunity, perhaps, only if the price is at an important level. At the same time, if the price is trading below these, it also confirms that the trend for the price is, for the time being, skewed to the downside, unless, of course, the price changes its direction and moves above that moving average, just like how the price was trading below the moving average and it crossed above that, right? Price was trading below that, and then it started to trade it above that. Again, it crossed below all the moving averages and then went up, went down, and then went back up. So that is the concept. But why these three numbers, you may want to ask? For institutional perspective, now remember, I have worked as a hedge fund trader for Bank of New York Mellon and also for Bank of America. Institutions always pay attention to these important moving averages, and then they tend to take the direction of the trade in that if the price is trading above, based on the analysis, if the price is trading above or below these moving averages. Now, obviously, the price has been, the price was way oversold, but it has recovered enormous amount of those losses, and it is in a process of challenging the DAX index, especially is challenging its 200-week and 100-week moving average. Now, obviously, this week's each candle represents 1 week. This week's price action is enormously strong. You can see that the DAX index is moving continuously higher. And then this is our resistance zone with respect to the DAX index. The price is going to come and challenge this particular index. But when we switch the gears and go into smaller term time frame, we can see that the bullish signal came a little bit before than the weekly channel on the weekly time frame, because on the weekly time frame we are still trading on a bigger time below these moving averages. But on a daily time frame, we had the signal in around at this area, because it was in at that area when the price crossed above the 50-day moving average. Remember, this is your 50-day moving average. When it crossed, it confirmed at the time that the bulls are getting the control back, and the prices are likely to move higher. Now, as of today, we have another significantly bullish signal coming out from the DAX index when the price crossed above the 100-day moving average. Now, remember, on a daily time frame, where our resistance zone is, it is where your 200-day moving average is as well. So this resistance zone, which we mentioned over here, is likely to put some pressure for the price. Right now, the momentum is okay and it is skewed to the upside. But what we want to see over here is that as long as the price stays above the 100-day moving average, and especially the 50-day moving average, we are likely to remain safe, and the price is likely to continue to recover its losses, and continue its journey to its previous highs, which is right over here. Now, this is your opportunity to ask questions if you do not understand what I have mentioned so far. Now, do you, let me just bring this. Sorry. Okay. I'm just going to go through some of the questions right here. Folks, can you guys, is the sound still okay? Yes? Okay. So anyone who is having a problem with the sound is their own issue. Is the issue is definitely on their side, because I just read a few messages where they were saying that yes, so they can't hear it. So guys, the problem is definitely on your side. Now, so do you understand the concept that I've explained to you guys so far? So if there are any questions, this is the opportunity that you guys can ask me any question that you have. Is the moving averages used EMA or smooth? I always use smooth moving averages. Okay, so most people can understand it. And remember, you know, there's nothing, no right, no wrong. You can always ask questions. All right. Okay, so let's continue our analysis on the different indices. They are all smooth moving averages, folks. Yes, the resistance lines are at the turning point of the averages, yes. What is the best strategy in your opinion for trading indices? It is up to you what strategy you want to use, but for me, it is usually the moving average is the one that I've shown you. What would you have foreseen the live spike down? How would you have foreseen the live spike down? Okay. You know, if there is any large movement to the upside, I don't know yet, but so far the price movement are looking very, I mean, the price movement is looking very positive, and I don't see this momentum fading anytime soon, unless of course if price starts to break below the important moving averages on a daily time frame. So that's the answer. Can we apply the same MA at lower time frame? Yes, you can apply, but remember, as we change the time frame, the moving averages also change as well. So on a daily time frame, they are on a weekly time frame, they are weekly moving averages, and on a daily, they are daily. So again, you know, the concept is going to be the same. Again, all video lessons, everything is available on YouTube, as I've shown you our YouTube channel. If I can show it to you, I can share you that again. This is a YouTube channel, so you just go to AvaTrade over here. That is me over here. So just go through all the previous videos. You can see, you know, what we have talked about and stuff. All right, so let me continue because we don't have that much of time. Try to answer some more questions at a later stage. Right, now we are going to move the analysis to Dow Jones index and then see what exactly is for this index. Again, you know, the index, we have the same three indices, three moving averages. The price action looks very, very positive because it has crossed above the 200-week moving average, and it is about to challenge its 100-week moving average. Now, when we switch the time frame and we go into a daily time frame, what we see is that, you know, again, the signal came well before than the weekly chart, because we knew at the time when the price crossed above the 50-day moving average that the bulls are gaining strength. The confirmation came right at this time, and then this is where our support zone is going to be, because that double bottom was really, really nicely formed, and then price retested it. So if the price does come, if there's any retracement, this could act again as an area of support. But equally important, this 100-day and 50-day moving average, they are also likely to act as an area of support. But the fact that the price has already broken above the 100-day moving average gives me belief that the price on a weekly time frame is going to challenge its 100-week moving average. What we're trying to establish from this is that we want the price to go above all the three moving averages. Once the price is above all the moving averages, or especially as long as it remains above the 200-week moving average, you know, it is highly likely for the price to continue to move higher and higher and higher, as you can see. You know, once the price moved above the 200-week moving average, it challenged the 150, and then after that there was a test of these two, but we had a very decent strength. Yes, there was a period when the price crossed below the 150-week moving average, but again, the price was well above the 200-week moving average. So because of that, the rally continued only until COVID-19 time period, the pandemic period, when the price crossed below the 200-week moving average. We knew at the time that there is some serious trouble, but that trouble has faded, or it has gone now, at least for now, because the price is back above the 200-week moving average. Now, in terms of our resistance zone, I mean, I see the resistance, I try to hit right at the top of these particular candles, and right in this area, so which is just slightly above the 200-week moving 200-day moving average. But remember, if the price clears this 200-day moving average, it is highly likely that the price is actually going to blow past this resistance zone as well at the same time. Why? Because the momentum at that stage is going to be very, very positive. So what is the next level of resistance? The next level of resistance is likely to be right around this area, right between, let me just bring the cursor to show you, is going to be just over here, starting from this particular point and goes all the way to here. So that's likely to be your next area of resistance. Now, when we are speaking of the price action, the 25,000 mark was also a very, very important psychological level, because remember, yesterday the actual cash market for the Nasdaq was only 5 points shy from closing at 25,000, and today the futures are already trading 348 points higher. So it is likely that it is going to go past that 25,000 mark, that will induce further a strength and further confidence among investors that this rally is really, really solid. Again, the concept is very similar. When it comes to your weekly time frame for the S&P 500 index, the major points, the resistance and support zones are already drawn. When we go into the weekly time frame, we can see that the S&P 500 index is much, much stronger than the Dow Jones index. Why? Because when we look at the weekly chart, the price is still below the 150, but when we look at the weekly chart for the S&P 500 index, it has already gone above that. Again, that concept of price being above the 50 and then above the moving average is already in play, so it is highly likely to challenge its previous all-time high. Now, when it comes to Nasdaq index, obviously this is the strongest index because it has not only crossed above these indices, but it is way beyond that level, and it is in very close to its previous, it's a previous level of a previous record high level, and because of that, I think it is highly likely for the price to break actually this previous resistance level as well. But as I was saying, the Nasdaq is the strongest index out of all the three indices. So the three indices being the S&P, because on the S&P the price is very close to this 50-day moving average. On the Nasdaq, it is way, way above all the moving averages. But when it comes to the Dow Jones index, the price is below the two important averages and just a little bit above that. So Dow Jones index is your weakest index. The second strong index is your S&P 500 index. Nasdaq is the strongest index. DAX is again your weakest index out of the four indices that we have talked about so far. And so you know where the momentum is. Obviously, the momentum is in the Nasdaq. Now momentum is picking up in S&P 500 index, and from so on and so forth. All right, folks. I am really coming towards the end of this webinar. So once again, I wanted to thank all of you for taking the opportunity to come out and listen. To take the time out, not to come out, but to take the time out to listen to this webinar. We appreciate your time, and we hope to continue this every single Wednesday as always. And once a month, there is more opportunity for you guys to join our live Q&A session. Ask me as many questions as you can, and learn more and then be better in your trading, right? All right, folks, that's all for today. Thank you so much, and see you guys until next time.